Hello everybody, this is Matador from freetradingvideos.com, and it's official, the markets are crazy. So it is November 29th on Thursday, and I wanted to burn a video about something that someone was asking in the forum about double tops and ascending triangles and M's and whatever you want to call them. They're all just certain patterns that you want to go through and understand about the relationships of the most recent swing high to the previous one and the most recent swing low to the previous one. Really, that's going to end up telling you more about the sentiment of that chart than anything else. So I picked just 3 symbols to talk about to give you an idea, and hopefully this helps. So if I have a stock and it's making a series of higher highs and higher lows, a nice uptrend of course, you can also see what happens when that stock starts losing momentum, right? And you can see that actually shifting just by the relationship of the most recent swing high, right, to the previous one, and the most recent swing high to the previous one than that. So just a little bit higher, but not nearly as high as it used to be. And the same thing would be true for the bottoms in here. All right, so all I do as a trader is wait for that stock to give me a nice entry. And so actually right here, as I'm looking at this, this is a very nice high base forming in an uptrend. So I would say to myself, if this stock can sort of chop around sideways until at least the 13 EMA, which is this guy right here, hugs up into that, that might be a good time to put a trade on. Nice stop limit order above $40, never right at the round number. Make sure the target is decent and that there's not a lot of overhead resistance very near. And I would take that trade with a nice protective stop below the most recent group of relatively equal lows in that stock as soon as the breakout occurred. So there's a nice breakout actually, and that's not bad at all. A lot of times stocks will fail a breakout. They call that a turtle trade. It kind of rolls over. Anyway, let's see what would happen with that one. Comes right back into the range, and right about that day I probably would have been stopped out of that breakout trade. If I had taken that trade, it would have been a little bit early. The 13 never really got a chance to come up into that, but it's close. So not too bad. So one little stop out. Let's see what happens in here. Alright, so now we've got essentially a double top forming here. After a nice little pullback, get a little horizontal line here. By the way, these are Thinkorswim charts. They're very nice. So basically a nice little double top. You can grab that, put it where it needs to go. This stock has now failed, at least in the short term, to make a higher swing high. And it doesn't have to be this dramatic, right? But that's a pretty good size sell-off. And now I've got a great chance after having the stock fail this miserably. 1, 2, 3, 4, 5, arguably 5 bars down in a row, right into an area of support here. Right? This stock is going to have a lot of trouble making a new swing high out of that. Right, this is going to be the basis of what Fibonacci retracements are about. It would take over 100% retracement, of course, to make that higher swing low, but it's a large sell-off. So there's even, wow, okay, well, nice lower swing high now. So this stock is now in deep trouble. So if I draw a nice retracement in here, good sell-off, lower swing highs. This is a big head and shoulders pattern as well as a double top. They call it M for murder, unless you're going short, which I would never do in the context of an uptrend. But there's that M trade, right? So there is a double top. I don't care what you call it. It's just failure of a stock to make a higher swing high and then a subsequent higher swing low. All right, so very good. Just to follow it out for fun. Okay, well, there's earnings, right? So you never would hold through earnings anyway. But this is a poster child for keeping your protective stop. Had I taken this little breakout, I would have been stopped out for maybe a 60-cent loss right here. So I don't have to turn something very, very small into something catastrophically large just because I feel like I have to be right and I'm going to wait for the stock to take off. Well, I've done that more than you can count, more times than you can count. So if the stock had come back to here and I would wait for it to come back, I might sell out, happy to get all my money back, if not just a tiny gain. Right? So that's not at all a decent way to trade because this stock could never have come back and could have ended up down here, you know, whether I'm there or not. So be very, very careful with that kind of psychology and make sure you're always keeping your protective stops and then being happy about being stopped out because this can happen. So a little added extra bonus there. Let me take another one here. I did a little bit of research before this, just to give you an idea. Alright, so here's a stock doing the same similar sort of thing. It's putting in a double top as well, right through here. Right, but this time it makes a higher swing low, rolls out of it, and goes right through it. If I go back in time a little bit, it's even more dramatic. And here's another couple double top in here. So let me grab this, put that in there. So this whole area becomes interesting for this stock. So let's step through it. It's holding up beautifully, right? And right about there, I start thinking to myself, this stock is holding up very nicely. If it can break out above the high of this, I might take that for a trade. All right, so very good. It's still the double top. It's even a lower swing high, arguably, than this one. But again, as a trader, all I have to do is wait for this stock to set up. I'm not going to touch it unless it proves its strength to me. So I come over here. In this case, if I hadn't been in front of the market, I would have missed that trade. It would have gapped up past my stop limit order, past the limit part of my stop limit order, and I wouldn't have been filled. I would have had to have done something like a 30-minute gap strategy or some anomaly of that to get in this. So waiting for 30 minutes, see how the stock trades. If you can never take out the high that it makes in the first 30 minutes of trade, put a nice protective stop below the open of that or the low of the day up into that point, and I would see if I could capitalize on that. Alright, so very nice. It holds up beautifully. Great run. There's a nice pullback there as well out of a little bit higher swing high. You can see that momentum is shifting a bit. Very nice. And then that's just a gift. Again, if that's earnings, which is not on this sheet because there's no little telephone here. Another nice thing about Thinkorswim, they post that. That's just a gift. All right, so very, very, all right, very good. So now let's look at another one. And this is sort of the culmination of all the things we've been talking about. I just wanted to make a point here. All right, well, here's a stock that runs up beautifully, just like some of the other ones had. It's going up very nicely, but instead of really pulling back at all, just the tiniest of pullbacks in here, it's actually basing on its high. Right? Very, very nice. It doesn't mean it's going anywhere, but after a big run like that, it needs time to take a breather. And any stock that doesn't pull back, doesn't sell off at the beginning of its life, at least not too dramatically, tells me that there are a lot of aggressive buyers in there with not very many aggressive sellers. Of course, there are always equal number of buyers and sellers. So what causes the stock to go up in price? Well, it's the aggressiveness of their buying. Right? There's not one more buyer than seller in here, or vice versa. So what in the world makes the stock price go up is simply how much is somebody willing to pay for it. Right? So if I'm a seller of that stock in this area, and I see a lot of aggressive buying, I'm going to pull my ask away and say, I'm going to wait and see how high this thing goes before I sell it. Right? So that's what I mean by not a lot of aggressive selling. When people really, really want into something and they want to own it, or if they really, really want out of a short trade because they see it's getting away from them, they're going to buy it or buy it to cover their short trade for more than the next guy or girl. So in this scenario, this tells me that there's a lot of aggressive buyers in there and not very many aggressive sellers. And when those things break out, like we tried on the first trade I showed you, every once in a while they will run in my favor. And that can be the beginning of a very nice move, especially when the 13, 20, other moving averages that you might choose to put up here kind of run into that and help support it. Even better when there's not a lot of overhead resistance behind that trade to knock it down, and the only thing that would stall it out would be profit taking. So 1, 2, 3, 4, 5 bars up in a row. Not a lot of new buyers jumping in there because they know that profit taking is coming and some people are going to want to start selling. So it's kind of neat to tear apart all the other people in the marketplace, understand where they are, what they're going to do, what they're going to be highly motivated to do in the future, and learn to wait until it's time to take a trade. And that's called market timing, and that's why technical analysis is so great. If you're going to hold stocks for very much longer than that, fundamental analysis is just genius on top of all that. And that could be a discussion for later as well. Anyway, I hope this helps clarify some double tops, how they're very similar to the beginnings of ascending triangles. All ascending triangles start their life off as double tops. And then high bases, of course, are even a little bit more powerful than that. So again, I hope this helps. Thank you for joining me on freetradingvideos.com, and I'll talk to you soon.